day bright and early and joining us here. My name's Lisa Davis, and on behalf of PearTree Securities, PwC and KPMG, I'd like to welcome you this morning. I don't get an introduction, so I'll start off just by letting you know I am the CEO of PearTree Securities, and I'm also the co-chair of PwC's Finance and Taxation Committee. In both of those roles, I think I've seen most issues that can come across someone's desk with regard to flow-through shares. I know I don't have to explain to this audience how critical the flow-through share regime is to the Canadian resource sector. About 2/3 of all of the financing for Canadian exploration that's done on Canadian stock exchanges is raised using flow-through shares. It's a brilliant system to incent investment, but CRA does look closely at how the funds are used, and we know that understanding the rules of the game is critical. I've just even talking to people this morning and over time, there's a lot of, I think sometimes frustration and inconsistency with the way CRA deals with looking at Canadian exploration expenses. The review is not done through just one taxation office, and there's been a fair bit of turnover in staff at CRA lately. So it's not completely surprising that there's been a bit of a lack of consistency in the approach by CRA staff. But I think CRA is making more of an attempt to get everyone singing off the same song sheet, and they've recently published a mining expenditure review table, and that's going to be the focus of most of the discussion this morning. So I'll start off with the obligatory disclaimer clause, which you can read at your leisure. And let me kick things off then by introducing our panel. So at my far right is Liam Fitzgerald, a tax partner with PwC. Liam advises clients in all stages of the mining industry with a focus on advising Canadian-based multinational corporations on structuring their foreign mining operations, dealing specifically with issues such as cross-border financing, capital restructuring, repatriation techniques, and M&A. Next to Liam is Gary Baschuk, PearTree Securities' own Gary Baschuk, a mining analyst and geologist who spent the past 12 years in capital markets and over 20 years in the mining industry. Gary's analytical focus has been on small to mid-sized exploration, development, and production precious metals companies. Industrial experience, all with Barrick Gold, ranged from early stage exploration across northern Ontario, Manitoba, and Quebec, plus development and production on two mines, Holt McDermott in northern Ontario and Rodeo Griffin in Nevada. In addition, on behalf of Barrick, Gary managed an exploration company in Spain. And finally, Michael Spinelli is a tax partner in KPMG's Canada's mining tax practice with over 18 years experience providing tax compliance, tax accounting, tax planning, and other tax services to large and medium-sized corporations over a wide variety of industries. Michael focuses primarily on providing income tax services to Canadian and multinational mining companies, serving both mine operators and exploration and development companies, as well as royalty and stream companies. So our agenda for this morning's program will start with some brief remarks just to provide an overview of the definitions of Canadian exploration expense and Canadian development expense, and a bit of a history of the guidance that's been issued by CRA to assist in the application of these legislative definitions. Following that, we'll move on to our panel discussion, and finally there'll be an opportunity for questions from the audience. So first of all, I'd like to ask Liam to give us a little CEE primer.
Good morning. So what I thought I'd do first is try and explain to everyone in fairly simple terms what CEE is and what CDE is, to kind of set the table for what the flow-through shares encompass. So The most common flow-through shares involve Canadian exploration expenses, which, as you can see up in the slide, they're the expenses that are most attractive because they're the ones that are fully deductible when you incur them. And when you're an individual investor, you're able to even create a loss to the extent you have a flow-through share. You announce CEE and you can claim it on your own T1, your tax return. And also, some corporations can actually also invest in flow-through shares to get the CEE on their books as well. So it's usually the most common. What it involves, it's an expense, and in Spinelli the word purpose, it's a purpose test. It's an expense incurred for the purpose of determining the existence, location, extent, and quality of a mineral resource in Canada. So when you look at it from an income tax interpretation perspective, when you see the word purpose, that's really, they're looking at what the reason is for the expense and not the result. And that's quite sometimes a misinterpretation people have, that they're looking for the reason why you're doing something, and less in, like for example, if you're drilling, they're looking at the reason for your drilling and not whether you're successful, for example, determine the test. So it's an important thing to consider as we walk through today. Then as an example, it's in the legislation, they provide examples of what they believe, and this is the Department of Finance believe is Canadian exploration expense. And the most controversial usually is drilling, because you can do a lot of drilling for a lot of things. Is it relevant to the test? And also this thing about testing, and they get a bit, CRA gets hung up on what is the right testing to be a Canadian exploration expense. In the second bucket, they're not called buckets in the legislation, I just thought it'd be easier to understand, is a Canadian development expense. Back in 2013, there was a change in legislation which recharacterised what most geologists or mining people would call just building the mine and putting it into production. Used to be a Canadian exploration expense, is now a Canadian development expense. The reason the Department of Finance at the time, and this is Mr. Flaherty who did this, took the view that this type of expense in the oil and gas sector was deductible on an amortisation basis at 30% declining balance in this case, the same as the cost of oil and gas property in the Alberta oil patch, and therefore he equalised the two industries. Whether that's right or not, I'm not sure. Again, it's a purpose test, and essentially it's any expense you incur to bring a new mine into commercial production is really how you determine it. The trick is, well, what is commercial production? Usually how they measure that is your mill capacity. So when your mill over a 3-month period hits 60% of its capacity, they tend to take the view that you're in commercial production. This is often different to most auditors and accountants will tell you. Hence a bit of confusion when I talk to my audit colleagues as what they consider to be in production versus what the CRA will. That's usually the litmus test of what they do. And that's a test developed by NRCan. And again, the common expenses are clearing, removing overburden, stripping, sinking the mine shaft if it's an underground mine or any other underground entries. So usually it's the shifting of the dirt. That's how I really simply put it. And the last bucket, which has become a little more popular, is once you mine, if you're an underground miner and you're already in commercial production, you can still have an expense which is flow-throughable as a Canadian development expense. It's typically narrowed to where you're sinking in your mine shaft, you're doing a new mining haulage way, you're doing other underground work after your mine has come into production. So if you've got one mine shaft, you want to put a second shaft in once you come into commercial production, it actually qualifies as a flow-throughable expense. It's been done a few times in the flow-through space, and it's something which is becoming a bit more popular. The other thing that came in the fall economic statement was this accelerated CDE. So instead of having what most people understand as a 30% declining balance deduction, for the next 10 years there's actually an acceleration of that deduction, such that up until 2024 you get an additional 15%, so it's 45%. And then after that, they ratchet it down until by 2028 it's been phased out. That matches some of the accelerated depreciation they're doing in the manufacturing sector. So in both the mining sector, oil and gas, and manufacturing, they've introduced this concept of accelerated depreciation. It's the typical government boots shovels in the ground initiative to try and get people accelerating through. So that's in place, and that is available to both the corporation and can be to the individual investor as an accelerated. So which means you can get more bang for your buck if you try and do a flow-through share on a Canadian development expense. Lastly, it's often something most questions I get is not what qualifies, but what does not qualify. It's usually a typical thing I get asked. and sometimes it's slightly controversial. So admin cannot be included in a flow-through share offering. Same as if you have an employee, a lot of people like to allocate like 50% of an employee to flow-through shares. You cannot actually do that. What the test is, you have to look at each employee, and if they're not substantially involved in the exploration activity, you can't allocate the salary. So and it's basically a 90% or more test. So you're looking at the person's duties, and you're not able to prorate their duties, so you can't argue your CEO is 30% involved in exploration, therefore I'll put 30% in. You can't actually do that. A lot of people do, and they get caught. So it's a 90% test. Same as if you're doing maintenance of a rental property. A lot of, when they're doing testing, often rent property. If it's not wholly in respect of an exploration activity, you also can't put it in. Lastly, you can't put in the acquisition of a property. I've seen that a couple of times where people buy a property and try and flow it through. You can't do it. And you also can't put through depreciable property. And it's fairly straightforward when you're dealing with smelters, etc. But when you're looking at roads, you can flow through a temporary access road, but you can't do a permanent road. When you're going with tailings, which essentially is pushing dirt around a lot of the time, it's a bit nebulous as to whether a tailings dam is exploration property or is it depreciable property. So sometimes it's a bit blurred, but generally you cannot flow through a depreciable property. I'll hand it over to Mike.
Thanks. Today I'm going to be just briefing us on some of the guidelines and the history. As Lisa had mentioned, CRA has issued this mining expenditure review table, which came out this February of 2019. So I'm just going to walk us through how we got to this particular document, and then that will serve for the purposes of the remainder of the discussion. As you all know, the definition of CEE has been in the Act for over 4 decades. However, there's still uncertainty, as Liam has indicated, as to whether particular costs satisfy the definition. Examples of costs whose classification as CEE is uncertain include those in particular around, at the time, conducting environmental assessment, consulting with local communities, and preparing feasibility studies. As you all know, they are a very integral part of the mining exploration process. In 2007, CRA provided some general guidance it would follow in determining whether expenses incurred at the exploration stage for environmental studies and community consulting would qualify as CEE. That also included feasibility studies. In this letter, CRA addressed 6 scenarios pertaining to the appropriate classification of community consultation expenses. The position that CRA took is consistent with, as Liam indicated, the purpose test, which is outlined in the CEE definition. To the extent consultation is taking place as part of the exploration process to determine the existence of a mineral resource, that would be eligible. At that particular time in 2007, if community consulting was to obtain a permit, that was not eligible at that point in time as CEE. That would be added to the Canadian resource property itself. And the same was for environmental impact studies and feasibility. March 1st, 2015, federal government announcement was aimed to support Canadian mining, which confirmed the costs associated with environmental studies, community consultations, should not be denied a CEE treatment solely because the costs were required to obtain an exploration permit or license. As the definition of CEE under the Act was amended to include an expense for environmental studies, community consultation, including such an expense undertaken to obtain a right, license, or privilege. And again, it's for the purpose of determining the existence, location, extent, or quality of the mineral resource in Canada. So they clarified a lot of uncertainty that had existed in the past, or they seem to have thought so. In 2017, CRA updated the guidelines for determining the tax treatment of certain exploration expenses that they had issued in 2007, and it was just to align the reflection of the changes in the 2015 legislation. So that was the first set of guidelines that were somewhat evolving as the legislation evolved. And then most recently, the CRA issued a mining expenditure review table dated February 21st, 2019, which describes expenditures that CRA reviews would normally qualify as exploration costs under the definition of CEE, and also outlines what would not, or their views. As they noted in their expenditure table, that it is intended to be used as a guide, which I assume a lot of CRA agents will be using more as a checklist process as they go and review these particular claims. And I guess that's all I had to share.
The first area that I want to get our panel to shed a little light on, I hope, is in the area of sampling and testing. I think Liam already alluded to the fact that that's one of the sort of murky areas that you might have to contend with. I find, I have a legal background, and I can look at the legislation and I see 4 or 5 different seemingly overlapping and conflicting definitions that deal with sampling. The newly released mining expenditure review table has tried to, I think, add some clarity around this. I'm not quite sure how successful it is. So let me just start off by noting a few things that appear both in the legislation and the guidance in terms of what would or wouldn't qualify as CEE when it comes to sampling and testing, and then I'm going to throw a few questions to our panel. So you've already heard a couple of times that the basic definition of CEE is an expense for the purpose of determining the existence, location, extent, or quality of a mineral resource in Canada, and that legislative definition specifically includes an expense incurred in the course of a number of enumerated things, one of which is preliminary sampling. Preliminary sampling is not defined in the Income Tax Act. The Mining Expenditure Review Table has some comments on this, and when it speaks to preliminary sampling, it says that it refers to the collection and analysis of mineral samples undertaken for exploration purposes. It's normally carried out prior to a decision to bring a mine into production. However, in certain circumstances, it could extend up to the commencement of commercial production if it's done for defining a mineral resource. And finally, if the sampling is done to help in evaluating the economic viability or technical feasibility of a project, it's not eligible. So preliminary in this context doesn't relate to the quantity of the sampling, but simply refers to a time period during which the sampling occurs. Now, there's also a definition of specified sampling as it relates to flow-through mining expenditures, which is the subset of expenditures which attract the 15% mineral exploration tax credit. In order to attract that tax credit, the sampling that's done to the extent it qualifies cannot be specified sampling, and specified sampling is defined in terms of the size of the sample, less than 15 tons, or generally less than 1,000 tons of sample from any one mineral resource in a year. And then finally, similar to preliminary sampling, bulk sampling is not a defined term, but it has been addressed in this new mining expenditure review table, which describes bulk sampling, again, in terms of a purpose test, being for the purpose of determining the effective grade, performing grinding tests, or determining whether any separation process allows minimum quality specifications. And the table goes on to say that bulk sampling is considered part of preliminary sampling as long as it's not related to an existing mine or the extension of an existing mine. It further goes on to say that bulk sampling expenses should be classified as CEE if the purpose is to test physical and chemical characteristics, but will not be qualified as CEE if it's used to evaluate the optimal processing method. So I'm going to ask Gary, first of all, looking at how a geologist would define preliminary sampling, can you clearly differentiate between sampling done to determine the quality, which is sort of the buzzword, in one of the buzzwords in the CEE definition, So can you differentiate between sampling done to determine the quality of a mineral resource and sampling for the purpose of evaluating economic viability or technical feasibility of a project, which CRA specifically states cannot be characterized as CEE?
I guess, first of all, as a geologist, I'd never heard the term specified sampling before. It sounds like a CRA rule. Preliminary sampling to me is always sort of going out in the field, taking your grab samples off your initial outcrops, maybe doing some channel sampling, some trenching on it, some initial drill holes, get a feel for what's there, possibly doing extensions on it, get a feel for the size of it. Once you get into sort of looking at some of the economic characteristics and stuff of it, I think it is somewhat of a gray area. Once you've decided things are sort of economic, you've already sort of made that decision. You've passed that line. And I just, as I said, I see a lot of gray area in that specifically.
So can either of our tax specialists weigh in on that? Is there something that you can clarify around that?
Not really, no. I think it's always when you look at, you always have to appreciate that it's a bunch of lawyers and accountants writing the rules. And so the concept of specified account sampling has been in the Act since 1974. So what they're doing is they're trying to massage existing rules and tack on. Like, Department of Finance takes something and just keep tacking bits on. So when you look at the definition, they just tack bits on. So they've never, and that's why they put a word like preliminary sampling, which probably made sense in 1974, and then tried to apply it in 2019. So what they try and do is kind of work backwards. They look at what they think qualifies, which is expenses to determine a resource, and then try to narrow down the sampling. And what they found on audit is people would use one sample for multiple things. So they would get a sample and they would test it for environmental, they'd test it for metallurgical, etc. But they try and get the whole thing through flow-through. And that's what they found a little offensive, that they'd spend a big amount of money on sampling, split the sample up to do different purposes, which some were qualifying, some weren't, and then they try and get the whole sample through as a flow-through expense, which the Department of Finance didn't like. So they started to nibble away at the edges, and that's where you look at the interpretation of trying to narrow that down to make sure that when you're doing a sample, it's for the one purpose. The problem is, practically speaking, as Gary said, when you look at the average, it's not a bunch of accountants doing the sampling, it's geologists and other people. It's never that simple. So it's always very hard to bridge between the guidance and what happens in real life. So it always comes, and we always tell people, it comes down to the framing of, you need to specify the purpose of the sampling and try and, as best you can, come up with that purpose at the outset and try and divide it up. And hopefully, and it's always, the paper trail is what's audited. No one's going to go out and watch your sample, but they're going to look at the paper trail to make sure the paper trail is clear as to why you're doing what, and can you allocate it correctly so that you're only getting a flow through for the correct expense. So that's why it's a little clunky. And the specified sampling came from the oil and gas sector. They created that concept because they didn't want people to go in, essentially mine, and then call it sampling. That's why bulk sampling is a bit different to specified, because they found that they came up with an arbitrary allocation because people would essentially start to do stripping and then call it a sample and then run the stripping cost through and do various things to it. And they found that they didn't want companies to flow through stripping either, so they come up with this weird concept of specified sampling. Specified's like saying it's system sampling. Specified's not really a word. It doesn't give you anything, but that's what they're trying to do, is making sure companies are really doing sampling. And can you argue a 10-ton block of dirt is a sample? From their perspective, no. So it's kind of why they do what they do. But it's a conflict between accountants and Gary.
I guess when you start layering in CRA comes in and audits this, documentation becomes fundamental because that's all they have. And so documenting purpose and trying to delineate between the various stages and purposes of the sampling. So, you know, it's effectively touching three hands. You know, the geologist, then it comes to the accountants or the tax individuals, and CRA comes in, and so it's being able to tell that story throughout and delineate between each portion of the sampling.
So I think we're going to come back to this a bit at the end, but I mean, the two things that I think we're going to keep hearing over and over again is, you've got to be consistent with that purpose test,
Yeah.
and documentation is really the key. I'm going to ask one more sort of more specific question, expenditure review table that's come out. So the table says that expenses for geophysical and geochemical surveys will only qualify as CEE provided they're undertaken during the time range of activities from prospecting to preliminary sampling. Yet geophysical and geochemical surveys are actually one of the list of enumerated types of expenses within the legislative definition of CEE. So, I see this sort of temporal or linear approach in the mining expenditure review table, but I think we're supposed to be looking at this in terms of the purpose. So I'm just wondering whether any of you have seen challenges from CRA that are related sort of, more to when in the mineral exploration sequence expenses are incurred as opposed to really like looking at purpose.
It's what the CRA is scared of typically is the period of flow through lasting forever. Because in the way I understand it, Gary, you can correct me if I'm wrong, you could probably sample forever throughout the mine life, particularly if you're doing an open pit mine and you're looking at expanding into a pit to a super pit, etc. What they're trying to do, it's not in the legislation, so when you look at the wording, there is no end date. They don't say it goes from A to B, that's exploration, and then from B to C is development. They just don't do that. So that's why and we'll talk about it later, the CRA is trying to put some goalposts in which don't really exist. So it's their interpretation. So when you're looking at what they're trying to do, they're putting the goalposts in of what they believe is an end point to an exploration and a neat starting point to development. And often when I explain that to people like Gary, they get a bit crazy on me because they say it's a continuum, that you can go backwards and forwards through exploration, you can delineate the resource, and you have to continue sampling. So that's where it becomes there's a conflict between interpretation and what the law says, and then what reality hits, because you can probably add as to what these terms are really used. Yeah,
and part of the problem, I guess, with geophysics, it's changed a lot in the last 20 years. So you can do a lot of downhole, borehole geophysics from, a deep hole at the bottom of a mine to some exploration hole a few hundred meters away, and you really don't know what's there. But running geophysics now, you can get a feel for if there's another mineralized zone outside of that, and that would be exploration, looking to expand outside of known areas. So I think that's somewhat of a gray area. You can't really say that geophysics and geochemistry stop once you start production. There's a lot of things you can do beyond that for new zones within it, which should qualify.
The other trick too is the trick with bulk sampling as well is it's not clear in the guidance. And with a bulk sample, what they don't tell you is that often what people take with a bulk sample is they'll take whatever gold they have, for example, if it's a gold sample, and they'll actually sell it more often than not. That revenue is meant to come back and grind your flow through. So when you're doing this sampling, and the CRA's caught a fair few taxpayers, sometimes you sell the material that comes out. And say if you did a $10 million flow through, use it to a bulk sample and you get $5 million of revenue, that $5 million reduces the amount that you can flow through, such that your flow through then became $5 million. And you have to then backfill it with more expenses from your own money. So when you're looking at the sampling, what they're not very clear on their guidance is that the revenue from that sample is meant to be equivalent to assistance. So it reduces the amount you can flow through. And there's no time limit. So if you hold your sample for 5 years and then you run it through, that still has a forever look back to the time they did the flow through, and a few have been caught by that. So that's why we always suggest bulk sampling is a bit of a dangerous flow through expense, because you can get caught. Particularly it's hard not to sell it.
Early guidance issued by CRA was back in 2007, and at that time feasibility studies were addressed. The guidelines that were revised 10 years later contain that same guidance with no change whatsoever. So in the guidance that goes back over a decade, certain types of studies were specifically identified as not meeting the purpose test. And those are reasonably clear. They start from sort of like very early where you're doing preliminary planning for potential exploration, but you haven't yet made a decision to explore. And at the other end, assessments of mine development options or profitability of developing a deposit wouldn't qualify. At the same time, certain types of expenses were specifically recognized as CEE, and those were physical and chemical assessment with the objective of informing a decision whether to undertake more advanced exploration, and studies related to the conduct of an exploration activity. So the newly released mining expenditure review table addresses in a little bit more of a granular fashion several categories of studies broken down into pre-feasibility, feasibility, and scoping studies, or PEAs, and defines them with reference to CIM and National Instrument 43-101 definitions, and states that both pre-feasibility and feasibility studies generally would not meet the purpose test. But at the same time, it refers back to their previously issued guidance, which is still in effect, which seems to contradict that somewhat. I'll start with Gary again on this one. I mean, as a geologist, how would you normally differentiate between these studies? And in particular, I looked at the CIM definitions in preparing for this, and even the earliest studies within their definitions talk about a study of a range of options for the technical and economic viability of a mineral project that has advanced to a stage where a preferred mining method, in the case of underground mining, or the pit configuration in the case of an open pit, is established and an effective method of mineral processing is determined. So it seems to me the CIM definitions are sort of incorporating things that would apparently disqualify a lot of these things. So again, with the geologist hat on, how do you differentiate between these different studies?
I mean, for the studies themselves, they basically have fairly good definitions, right? Like a PEA is your first stage to see, do we have something here that might be economic at all? And you run through some numbers just to get a feel for it, a plus or minus 30-35% accuracy on that. When you move into the pre-feasibility, you're tightening it up a little bit, you have higher density of drill spacing, you're into a 20-25% accuracy on your costs. And when you go to the feasibility, you're a 10-15% accuracy in the costs. So at that point, you've got tight space drilling, you have ore blocks defined, they have a cost associated with them. So once you're there, we know that you've pretty well made that decision once you're going into the feasibility study. And as to whether you're going to go an underground or an open pit operation, that's also, I think, fairly easy to tell early on. It's going to be defined by the orientation of the mineralization. If it's fairly flat near surface, you can mine it as an open pit. If it's steep, dipping, you'll look at it as an underground, possibly an open pit if it comes right to surface and daylights. You'll get a feel for that fairly early on. And from the drilling, again, you can get a feel for the extent. Just keep stepping out. How big is this thing going to get? And take a look at some strip ratios with ore to waste. So you can get that. I guess one of the things you mentioned too is the stage of the project insofar as the identification of mineral resources versus reserves a relative factor. And the fact that you've said that it's reserves means you have ore blocks, which means you already have, by definition, ore is that you can mine economically or you at a profit. So the fact that you've got an ore and a reserve, you're already at that point. So basically, you know the existence of it, you know the location, but for pre-feasibility PEAs, you don't know still the extent and the quality. So, that's stuff that still has to be answered.
So one of the things, and maybe Liam or Michael can chime in here, is I noticed that this new table also states that scoping studies generally would not meet the purpose test since they involve economic analysis. And I mean, Gary and I were talking about this a bit, and the scoping study seems to be like an earlier stage thing, yet I don't know whether, there seems to be an assumption in the latest CRA guidance that the purpose is not exploration. So from the tax practitioner's point of view, do you have anything to add?
Can we take that one, Mark?
Go ahead.
You want me to do it? Okay. I think what they're looking at is, and it's fairly simplistic, again, it's fairly simplistic because it's a bunch of accountants. They're basically, what they're trying to say, and it's where we always, when we see a company which has a PEA study, we get nervous that they won't be able to do a flow through on a simple term that the CRA takes the view that once you've defined the resource, then you've met the test, and therefore the goalpost stops, you're out of exploration. They don't like getting into the nuance that if you found 100,000 ounces, but you can expand it to 1 million ounces, they take the view that that's outside exploration. I don't agree, because you'd argue that the more drilling you do through the PEA to pre-feasibility, if you keep adding to the resource, it meets the test. But at the moment, they've taken this fairly arbitrary view that once you've defined the resource, they read into that definition of the resource way more than they do the quality and extent. So to Gary's point, the quality and extent, you can keep going and adding to the resource all the time, and you still should qualify, and it doesn't matter what you're doing. The CRA takes the view that as soon as you've defined the resource, and it could be 100,000 ounces as an example, then your exploration activity stopped. You're no longer in exploration. Not sure what you're doing at that point, but you're not exploring as far as they're concerned. So what then they're looking at all the studies at that point. They're arguing are determine whether you can build a mine, is their simplistic view. So when they're looking at a scoping study, feasibility study, it's all about economics, is their view. If it's all about economics, it doesn't fit the test. If it doesn't fit the test, they kick it out. So typically when you look at it, the first thing when we have a CRA flow-through share audit, the first thing they'll kick out is anything called a feasibility study. They just kick it straight out, arbitrarily. And they've been doing that for probably about 7 or 8 years. And it's been untested, so no one's actually tried to challenge them on it. Maybe they will soon. But then they take the view that, and then the reasoning is, and they've pulled out, there's a little, there's a small, like a paragraph as obiter in a court case, which they claim supports their view. And I've pointed out, because I'm a lawyer as well, that it's not exactly on firm footing. But until someone challenges it, that's the view, and we'll have to see where it gets there.
Yeah. One of the problems with a preliminary economic assessment or PEA scoping study is you can use inferred resources in that. And inferred resources they're not as solid. I mean, you really don't know. You're taking wide distances and saying that the mineralization continues across that whole area. You really don't know. You don't know if you've got splays coming off, if it's continuous or not. The only way is doing tighter space drilling in that. And that's, trying to find out, again, the extent and quality of it by doing that extra drilling. So to me, including a PEA or scoping study, there's still a lot of work that should be CEE eligible for that.
And so CRA, I view is very linear in their thought process. There's a start time where they're trying to determine the existence, location, extent, or quality. And then all of a sudden, when you get to a certain phase, the goalpost goes up, and anything post that is now economic viability. So I think playing within the guidelines or the goalposts, you're somewhat safe, because again, that's what they're trying to do is try to kind of ring fence the activities and have everyone apply to the guidance. But I think there is some interpretation and some area to go beyond that.
So sort of a good segue into the next topic. Liam, you said that you get to that goalpost and then sort of, where are you? What is this expense if you still, in your view, you're exploring, but doesn't seem to be CRA's view. So we heard already that there was a change in the law that transitioned over a period of time, and pre-production development expenses are now CDE, not CEE. And they're also defined with reference to a purpose test. CRA takes the position that some expenses incurred in connection with bringing a mine into production don't meet the test for inclusion in the category either of CEE or CDE. they view studies that are undertaken for the purpose of determining whether to bring a mine into commercial production, as opposed to, expenses that are actually pre-production development as sort of being in no man's land. And also, it was mentioned that anything that's considered part of the cost of acquiring a Canadian resource property or depreciable property are neither CEE or CDE. And there's been some discussion. I think there's disagreement in the industry, although it would be great to have certainty, where do we draw that line? And probably most people in the industry would disagree with where that line should be if they were talking to the Department of Finance. So is there anything that the panelists can suggest in terms of, even though we don't have a bright line test, while not wanting to give up on amounts that could be eligible as CEE, that is sort of that goalpost where you would suggest that you stop to be on the right side of the line?
We meant to change that.
Right. Oh, thank you.
Yeah, typically what we've looked at, if you really want to if you don't want any controversy in a flow through, you typically stop at the time you have your PEA study, because often the CRA will take the view that in your PEA study, whether it's, and they don't get into the nuance of inferred or probable and proven and stuff. For them, that's kind of all murky, and it drives people nuts, but that's their view. So as soon as you have a resource in a PEA study, they're taking the view that you've stopped exploration, rightly or wrongly. So that way, at that point, they're saying that's the first goalpost. To Mike's point, that's the first time that you stop exploration. Between that point in time and the time that you make a decision to actually build the mine, that's the no man's land as far as there is concerned. So if you've done your PEA study, you're working towards pre-fees and fees, but you're not willing, or the board's not willing to make a construction decision, that's where you're in the zone where the CRA will likely challenge whether you're eligible to do flow through. That's where they're at. And as soon as you make a production decision, or you're making a decision to construct the mine, that's when you're in the second paragraph of pre-production development expense. My view is it's a continuum, so I don't agree, but at the moment no one's gone to the court to challenge it, so we're kind of stuck. So if you're looking at doing something which is uncontroversial, that's what you're looking at. Is you can do a CEE flow through up to the PEA study, and you can do a CDE flow through once you've made the construction decision. If you're in between, you're probably going to get challenged on either the expense or on the whole flow through itself. And it's what they often do, and it's where I don't agree with their position, that what they'll often do is recharacterize your exploration expense as just an operating expense. I've argued, well, if it's an operating expense, but you've said that they're not actually operating, how can it be? It's got to be something else. So their view is they're being generous, that they're recharacterizing it from an eligible expense just to an expense, even though they're also arguing that you're not in business yet. So it's a bit a dumb position, but that's what they do. So the question is, well, at some point someone will have to take that to court. Maybe a few people in the room will, to try and challenge that, because my view is it's a continuum.
Well, one other area where I think there's maybe a little bit of a gap is it involves expenses that could be considered to be related to a mine that's already come into production in reasonable commercial quantities. We heard that sort of rule of thumb. Do you find, I think Gary and I had talked about this, you could have a mine that's come into production and be exploring in the vicinity, or you could be exploring on property where a mine's been abandoned. Is there anything that you'd like to offer in terms of some guidance around staying out of trouble in that area?
Do you want to handle that one, Mike?
You go ahead.
Oh, you want me to? Okay.
No, you're
There's this concept called a new mine, which is a bit strange, because my view is unless you're really going into moose pasture and digging a hole, there's not that many new mines. So when you're looking at, a lot of people get It's always, if you've got an existing operation, which for example is an open pit, and you're doing drilling just outside the pit, and your view is that you'll just expand the pit to encompass that, they'll probably take the view that that exploration expense is just an operating expense. Versus is the expense in respect of a new mine, because you can only do an exploration of a new mine prior to its commercial production. So you always have to, and that's where there's a lot of rulings from the CRA where they'll get NRCan to help them determine whether the expense relates to something which is new versus a continuation of existing. You cannot do exploration in a continuation of an existing mine, particularly above ground mining, versus you can if it's considered a new mine. And what they look at for new mine is not whether it's a new resource, they look at whether it's new infrastructure. So we have success where it's going to be a new pit, or you'll have to truck it a long way, or you have some other infrastructure play like new tailings facilities attached to a new pit versus an expansion of an existing. And there's a lot of grey areas in this. And also you're looking at whether if it's an old mine that's a restart, like the most famous case that we were involved in is Detour Gold. It's been a new mine 3 times at the same location. And mostly that's because it was an above ground mine and it was owned by Dome, then it became owned by Placer. Dome went underground and a ruling was issued and went to court saying it's a new mine. And then the new guys came through and they made a new open pit mine. And again, we got the CRA to agree that there was enough lapse of time and it was a dormant property such that it was a new mine again. So you've had basically the same block of dirt been a new mine 3 times. So there's no clear test, but it's a matter of, it's a question of fact, but you have to make sure that if you're doing drilling in respect of an existing property, it actually has to be a new mine. That's where it's a very factual determination, which the CRA leans very heavily on NRCan to help them make that determination. So if you went into the NRCan website, they'll actually have materials in NRCan website about what they consider to be a new mine, which is not bad. They're actually pretty good at it, to be honest.
Thanks. So the last topic before we get into some more sort of things around process, I would say, is a little bit around earning into a project. This isn't specifically something that was addressed in this new mining expenditure review table, but it's come to my attention from a couple of different sources that it seems to be the subject of some interest of CRA lately. And, you know, as I'm sure most people in this room know, that earn-in or farm-in arrangements are a very typical way for a party with an interest in a resource property to finance the exploration and development work on the property. So if a company raises flow-through dollars to be spent on CEE, those funds can be put toward the work undertaken to earn an interest in the property. But that's not the end of the story. While you don't actually need to own an interest in the property at the outset, if the funds flow in such a way that CRA considers them to be part of the cost of acquiring that property, then the classification would be CDE, not CEE. And in the flow-through context, most of the categories of CDE are eligible to be renounced to a flow-through subscriber, but the cost of a Canadian resource property, while it forms part of the company's CDE pool, can't be used for flow-through purposes. So I'm wondering whether, I guess this would probably be for Liam or Michael, if you can give us a little bit of more elaboration around, you know, how these things should be structured to stay out of trouble.
Like earn-ins are they're like snowflakes, they're all different, but I hope people think they're all the same. But I think earn-in is basically an administrative exception to the Act, where normally if you were trying to sell a car and you asked your friend to kind of repair the car and you'll end up buying it if you spend enough money on the car, is considered to be a disposition between 2 people. In the resource sector, it's not. It's weird, but that's the way they allow it. So as long as you, and it's fairly common of how people want to explore a property is, if you spend money on the property and it's an X amount, then you'll end up earning an X percentage of the property. but it's not a disposition of that piece of property from one party to the next, and they allow that then expense to be called an exploration expense. And it's a fairly archaic ruling. It was created in like the 80s, and there's only been a few interpretations on it. Usually the trick, though, is they say you can only do an earn-in on an unproven resource property. Though I've talked to people like that, and you can probably elaborate, Gary, as to what an unproven resource property is, because I don't know. Because if it's unproven, most companies don't go exploring on something unless they know they have some inkling that something is there. Then to say something is unproven seems a little difficult, but I'm not sure they can.
I agree. I mean, first of all, the word resource means that you have something there, but resources change all the time based upon the economics of the mineral that's there. So again, it's a gray area.
So that's the problem, is because so if someone says we want to do an earn-in, we give them the rules, and they see that word unproven, and they usually come back and say, what's that mean? And I say, I don't know. Then chaos ensues a little bit. But usually what it is, usually the trick with earn-ins is the CRA doesn't get too hard on that point. What they get hard on is if people make them a bit tricky. So you add in warrants or you add in other sweeteners or incentives, can taint what they call a tainted earn-in. The problem is you either have an earn-in or you don't. There's no shades of grey. So when you add in features which aren't simplistic, then you have the risk of the whole earn-in just cratering. So for example, there's a ruling that we applied for which was denied, where a company wanted to incentivise the person earning in with warrants. So they gave them warrants and also earned in. And we asked for an interpretation of whether that was an earn-in, and they said no, because the warrants were an incentive or an inducement to earn into the earn-in, which is not a simple earn-in, and therefore they said it didn't work. So we had to disentangle the transaction. They end up doing the warrants through another instrument, but we couldn't wrap it into the earn-in agreement. So it's just the guidelines are very simplistic. There's not much there. So you're better off keeping them as simple as you possibly can. If you make them more complex, you just have a risk of the whole thing cratering.
Okay, thank you. So before we get into questions, the last couple of things that I want to talk about are, I guess, less of the substantive issues and more with regard to, how you can handle process both before and potentially after you're being reviewed by your friendly CRA auditor. So I know, in our office, we're a tax-focused shop, and when we're dealing with tax matters, we always take the position that it's not good enough to be right at the end of a dispute with CRA. I mean, we've heard here there's lots of times where we think CRA is wrong, but once they're hanging around, it's can take a lot of resources and time and energy to get to the result you want, and I think many people give up. So the key is let's be more careful up front, and documentation is critical. So that's been alluded to. So I'll just open it up for any comments as to where and how you can give us some pointers on documenting things that will help an auditor check the right boxes.
Well, I think first and foremost, before you get actually into the documentation, I think is communication between the team out in the field and the finance team to understand the various phases of what's going on. Because it seems to always happen that the team out in the field is going through processes, and then all the information gets fed into the tax and or finance department, and then they're starting to try to sort through everything. But I found that with companies that integrated that system in terms of having the geologist talk to the tax team and the tax team talk to the geologist, there's kind of a thought process and an understanding of what's required and what the timeline looks like. So usually that's my first thought process in doing that. Documentation in of itself, I don't know if anyone wants to touch on documentation. I think when it comes to some of the documentation up there, understanding the purpose, of course, of each invoice, PO, report is key. because a lot of the a lot of those materials are just payable to and for this particular service. But in my view, it's understanding and actually papering or documenting the purpose of each of those expenditures incurred. I don't know if there's, did you want?
Yeah, I think the only thing you got to remember is it's a bunch of accountants.
Yeah, that's true.
Looking at it. So what they'll say, they look for buzzwords. When they turn up, most of them have no training in mining. Like we actually held a training session for the CRA. And they had like 200 people show up. I probably should have charged for it. Because you quickly realise that people who are auditing it, they might have been doing pharma companies or small businesses in Mississauga, and now they're doing mining. And so you've got to realise that they're accountants who will be given a list of buzzwords. So they'll see the buzzword feasibility study is out, and like drilling is good. Sampling, who knows? And that's how they do it. So what you have to look at when you're documenting it is appreciating the audience doesn't get a lot of the stuff that a VP exploration talks about. Like Gary would probably send them in a headspin of talking about all this geophysical stuff and things is all news to them. So the way we tell people to frame it is, one, be careful what you give them, and two, make sure you're framing it in a reference that they understand such that they know it actually leans towards qualification, and not just simply give them what they ask for, because they'll ask for everything, but they'll go straight to your trial balance and they'll see, like often accountants will put feasibility study and put like $6 million beside it. Then you'll get a notice of proposal of reassessment back which denies that whole category, because they're very simplistic. So it's getting down to that granularity and how to present the information. So you'll have a lot of documentation. It's about that taking a second to present it such that the people who are CGAs normally, often the CRA is one of the big employers of people who come from other countries. So you could have like a CGA from India doing your flow-through shares who's never done it before. So you have to frame it in how they understand it. It's probably the key.
So I think that the new expenditure review table, it's a bit of a double-edged sword, because CRA, I guess, is trying to draw those lines where it makes their job easy and they're being relatively conservative. But by the same token, for the first time, I think we've got some words that are being used internally by CRA to be able to help guide the way things are written up in contracts and purchase orders and wherever, that will maybe for that auditor that's, working off that same table that you are, help them check those boxes. Sometimes we'll find that, we're facing something leading up to a reassessment. From where I sit, we deal at PearTree with a lot of significant subscribers for flow-through shares. And if a situation occurs where there's potentially a denial of a deduction for them, my advice would be to be as prompt and as transparent as possible in dealing with the matter. There can be fairly short timelines when it comes to steps that have to be taken in dealing with CRA, and interest, the policy of CRA in terms of the interest accruing on these things, I think is pretty draconian. So by the time something is actually settled out, even again, if you're like partially right, the tax bill that hits a shareholder can be significant. And until a number of years ago, limited partnerships were the biggest purchasers of flow-through shares, and that landscape has shifted dramatically with the flow-through donation platform that's available. And rather than having a pool of dozens of investments in a limited partnership where the investor is facing the promoter of the limited partnership, not the company, and if one goes sour, the impact isn't that great. You now have a much greater chance of having a significant shareholder be impacted materially, and the reputational risk there is great, and of course everybody wants to be viewed as in as good a light as possible in terms of future financing. So I know we're talking here more to tax specialists than the audit side with our panelists, but is there anything that you can share with us in terms of an issuer's financial disclosure obligations when CRA is disputing the classification of an issuer's expense, or when there's a reassessment, and how that, can be handled as far as shareholder communication?
Sure. It's more controversial usually. Usually, because it's a civil liability, so it's a contractual liability, so it's kind of outside the realm of tax. That's why if it happens on our audit, especially in the junior sector audit clients, I tend to run away, because it's, in theory, it's just a liability. What typically happens is you set the liability up, but I think I've had a few. What most executives want in mining companies is for the issue quickly to go away, and their first reaction is, can I cut a check? So that they ask the auditor, or they ask me, can I just simply pay the CRA the $2 million that it might be and not reassess the shareholders? It's usually the reaction of many. And the answer typically is no. And again, chaos ensues because they don't like that answer. But the reason for that is you can't pay someone else's tax liability. So if you're an individual issued a flow-through share, normal reassessment periods for individual taxpayers is 3 years. Unless you buy a flow-through share, then they tack on an extra year. I think it's an extra year, to give them a bit more bandwidth to reassess on that point. And it's the individual's tax liability. So if you did cut a check for your shareholders, it's actually a taxable benefit to the shareholders if you paid their tax for them. So therefore, you'd have to basically then issue them another form which says, I just paid your tax for you, so now I have to assess you tax on the tax I just paid you. It gets pretty messy at that point, because then this whole point of trying to fix it for them kind of goes out the window. So the best way, as Lisa said, is to be transparent. You kind of set up the liability on your financial statements for the potential liability. More often than not, only half the shareholders either noticed or or it's insiders as well. So you tend to be a bit easier on the company if it's an insider, but you typically have to work through it very transparently. And you try and help them. And interestingly, an individual can, if a company gives up on the issue, the individuals can still pursue it. So if you believe that you had a valid flow through, the individual can object against their own tax return and challenge the CRA's position even without the company being involved if they really want to. I've only seen it happen once, but they can, because you're actually unhooked at that point. If you're technically speaking from a legalistic perspective, you could go to the Department of Justice yourself and ask NRCan to review Exco's flow-through share offering to take a viewpoint for your tax return if you really, really wanted to. It's going to cost you a lot of money, but you could do that. So that's where it's a little unhooked, where sometimes the companies think that it is hooked together. It actually is not. So it's an interesting conundrum.
And I do think that a lot of companies are conservative when they do their flow-throughs because of that, the reputational risk that they don't want to face, and then the actual quantum of the penalties and the actual out-the-door dollars that may occur as a result of an audit on the denial.
Okay, I think we might be running a few minutes over time, but hopefully folks can stay, and I'll open it up for questions. I would ask that you don't, give us a 10-minute story about your particular problem that you're having with CRA at the moment, more of a general nature, and that's for two reasons, because I don't think my PwC and KPMG friends are going to give specific advice now. But the other thing is that I have been in a dialogue with some CRA representatives, and they are quite open to having more questions, sort of a general application brought forward to them so they can further clarify the guidelines. So, anything that we hear that we can bring back, we will.
Yeah, Liam, could you expand a little bit more on that new mine concept and how that works? Because there's a lot of projects that perhaps have been rehashed or could be rehashed where it may have even been taken to a BFS level, but weren't financeable, And years later, maybe still within that same entity, or that entity gets acquired, and new parties are trying to advance the project and say, hey, I need to do some more exploration to expand the resource to hopefully create something that could actually be financed and put into production.
Yeah, sure. Thanks, Derek. It's a question of fact, which isn't helpful. So what they normally look at is infrastructure, and the length of time a property is dormant. So if a mine has ceased and then someone wants to come in and restart the mine, what they look at is, are you going to simply put the keys in and restart and get going again? So that's not a new mine, it's a continuation of an existing mine, versus like the reason Detour Gold became 3 mines in one is because of the length of time and the difference in methodology. So a good example is where if an underground mine typically floods after you finish mining, if you then have to deflood it, typically a good sign that it stopped, unless you can find scuba gear to mine it. So that's why underground mining's a little easier, because often you have to dig new shafts, get new infrastructure. It's a little easier to prove. Above ground's a little tougher because often you'll try and use the same pits and the same methodology, and it's mostly whether the infrastructure's there. It's always a little tougher. So you tend to find that you tend to go to the CRA for guidance. So that's why when you look at, there's a lot of rulings on guidance. So Detour Gold itself went to court once and got a ruling the second time to get guidance on it, because it's very hard for someone like me to tell you definitively either way, because it's so fact-driven. I've seen CRA now currently arguing that a flooded mine was deflooded is the continuation of the previous owner, despite the fact it was flooded and all the stuff underneath they left everything. They basically let it flood and everything was left underground. There's all underground equipment was still there and all rusted. The CRA is going to take it to court that they believe that's a continuation of an existing mine simply because it only flooded for 18 months. So it's a little nebulous.
Who's got the mic?
My question is, what is the, if there's exploration activity after a resource statement, not a PEA, so a company does say a resource update, I guess, or a resource, first time it's done a resource, then after that, the exploration activities, is that CEE or is that CDE?
Go for it, Mike.
I guess my first question would be really what was the purpose of the report, right?
Okay, the purpose, let's say a company performs some exploration activities and then decides to calculate a resource. So it's not doing a PEA,
right?
By doing a resource, there is some economic background to that, like a cutoff grade, etc. So as part of the ongoing exploration, you do a resource statement, and then maybe a year later you do a PEA.
Right.
So that period, if you do exploration activities, is that CEE or is that CDE?
Probably, yeah. Probably. The thing you have to be careful of, and that's where it's always the documentation. If you go public with a PEA study, you've gone public with your resource statement. So the risk you have is if you go public with early results to say you have a resource of X, your risk is the CRA says, well, you've now got your resource and therefore you've stopped exploration. So it's a push-pull between wanting to go to market with all your success versus the CRA saying that your goalpost just went up, that if you're building on a resource, you're no longer exploring. I don't believe it's right, but that's the risk. So I would take the view that, yeah, it is exploration. The risk is the CRA disagrees because if you go to market with one resource and your PEA study updates that resource, they may argue that you put your goalpost up the first time, not the second time.
Okay, just to follow up, if you acquire a property which has historical resources, it's been well drilled out, but you then do some exploration work, is that CDE or CEE?
It's either CEE or an operating expense. It goes back to Derek's point of are you using new methodologies? Is it different drilling? What is it? What are you doing? It's very much fact driven. So if you're doing a different array of drilling, or you're drilling a different area, or you're going deeper, or you think it's something different, then you tend to be still in that exploration continuum up until a point in time that someone throws out a resource estimate. So your risk would be if the first person came out with a resource estimate and did a PEA study, then gave up, and you come in and try to do it again, your risk is that resource, you latch on to that initial resource estimate. So the way mining works in the Income Tax Act is they really ignore the owner, they look at the property. So you could have 6 different owners, but your fate is tied back to the original owner. It's these things called the successor rules, which kind of create that, which I won't get into. So your fate is tied to the previous owner. You don't get a fresh start just because you're the new owner of the property, which is unfortunate, but that's kind of the way it works.
Sorry, we'll just stay on this whole idea. So I guess my question, you actually used the word property just now. So I guess my question is the resource, we're doing a resource estimate at PEA, is the actual tax rulings, or whether it's CDE or CEE, applicable to that physical space where that resource was estimated, or to the property, which may be 50 times the size and may have other targets to explore?
You're hoping for an answer there, aren't you? It's usually delineated to the space that's within the study. So if you have like a 50,000 square kilometres, but you're only on a corner, then it's only really attaching to the corner, not to. They don't. I've never seen them go beyond that, because we got a ruling on someone who started a mine and then delineated a resource 10 kilometres away on the same property, and we got a ruling to say there's 2 different mines. I'm sure that helps. So.
I have just one quick question. There's safety in getting a ruling. How long does it? I know that every fact pattern is different, but typically, how long would it take to get a ruling on a relatively straightforward issue?
Depends if, the problem we have right now is, because there's a woman called Fiona Harrison who was at the CRA leading the resource sector for like 20 years. Unfortunately, she retired. So, and Fiona was really good because we could get a ruling from her in 3 months. There's now a new crop of people in the resource sector. They're at 1 Front Street, that's where they are. It takes about 3 to 4 months, Ron. Unless they think we're doing something silly, and then it's 6 to 9 months, but typically 3 to 4 months.
Hi, sorry if this is a bit of a redundant question, but just for the sake of clarity, in terms of the resource estimate moving from a CE to CDE,
Yeah.
the comments that you're making with respect to the application of flow-through, is it in relation to the resource estimate or in relation to the resource estimate within a PEA? So if you're developing a resource estimate, are you suggesting that you are now moving into a CDE?
Maybe. It's where, the problem I have is it's just because the rules are so nebulous and fact-driven, it's very hard to give a definitive answer. The risk is if you define a resource of any kind, you're not exploring anymore. The problem is you don't develop until, in the CRA's view, you've made a decision to construct. So if you've delineated a resource, it could be inside or outside the PEA. At that point, you've stopped exploring. Because you've delineated a resource.
Let's assume there's no PEA.
Yeah.
So effectively, you've delineated a resource estimate based on some drilling, and you've raised some more money to effectively advance on that resource estimate, to build out to...
Yep.
So is that still a CEE?
Yeah, in theory it is, yeah.
Okay.
You take the most famous case is Rubicon.
That's always famous, but...
It's a famous Rubicon was doing flow-through shares right up in the time the company failed.
Right.
And they hung their hat on the fact that they never ever went, if I recall, they didn't do a feasibility study. So they kept it going and going and going, and they did flow-through shares within 6 months of them saying they can't operate the mine, which is a bit weird, but they were actually using the rules to their advantage, that they never actually delineated anything publicly. Going to CEDAR, they didn't go through the process. And then they tried to operate, and they kept doing flow-through share because their argument is they never delineated a resource.
Which they proved themselves right, but yeah, thank you.
Yeah, we could argue that, yeah. And that's where the rules worked in their favour. They worked the rules in their favour, arguably. So.
Anyone else? No? All right, well, we've run a few minutes. Oh, one last question?
Well, it's more of a layup because we know the answer. But in terms of the importance of documentation, I know there's been a discussion in our shop, and I think with Liam recently, about the difference in an earn-in where the check that's being written is written to the issuer or to the manager of the site of the project, rather than directly to the contractor, and how one would be considered, just a payment on account of the acquisition, and the other would be on account of the earn-in. Do you want to just speak about that, because it really highlights just how important documentation is?
Yeah, what we typically do in an earn-in, because it's unreasonable to expect that the person earning in is going to wheel in their own drill rigs and trucks. It's just not going to happen. So what we often build into an earn-in agreement is an agency agreement, where the operator who owns a property may act as agent for the person earning in, such that if they're doing work for both of them, which can happen, the one party's acting as agent for the other so that the expense is properly incurred. Because otherwise it gets unreasonable that are you really going to expect two companies to drill on the same property with two drill rigs in order to qualify? So to do that, we often make sure that there's evidence of an agency in place, such that if there's one person doing all the work, they act as either as the operator or as agent for the other party to make sure it's clear who's doing what and what expenses are being incurred. So you tend to embed that in every single agent. We put it in every earn-in agreement, whether it's needed or not, just to create that paper trail.
Okay, so I mean, I think probably if there's any takeaway, documentation is key. And even in some of the questions around studies and all that, I know there's been situations where there's work that goes into a study, and if things are documented as just being for the purpose of doing 43-101 report, the CRA could take the position that that is being done just to satisfy regulatory requirements as opposed to, the underlying work, which is exploration work. So with that, I want to thank everyone for coming this morning. I want to thank our panelists. Contact information is up there. If anybody wants to reach out, we'll probably be staying around for a few minutes if there's anything that anyone wants to talk about. I don't know if anybody saw them, but our good friends at PDAC have brought some brochures on flow-through that have a bit more of a slant towards the investor, but has some pretty good information if anyone wants to pick those up on their way out. And have a great rest of your day.
Thank you.